Hello, everybody. Welcome to Friday and another Talk Money with Tom show today. Really excited to have everybody here. Really enjoy all the questions that come in. We've had some questions come in this week. Going to do some deep dives on some things actually. And Eason's joining me today. If you have questions, he'll be the one that's kind of moderating, asking additional questions, and filling in other information also. You can send that to Ask Tom at talkmoneywithtom.com, and he'll get those, and we'll answer those as best as we can. We specialize in retirement. We believe that one of the best ways to enhance your retirement is to learn about retirement planning, tax planning, and investment management. The more you can learn about those three areas, the better chance you have that your retirement can work out. And I personally, I feel now that I've been doing this for so long, retirement is one of the great goals, certainly financially, and could definitely be one of the most rewarding. So the more you can learn about that, the better. And that's what we tend to focus on here across the board. And so really, if you're interested in getting additional content, you can hit the subscribe button and then hit the little bell. You'll get notified. You can join our email list if you'd rather not do that, and just send it to ask Tom at talkmoneywithtom.com. Or if you're interested in an appointment because you have something more custom or personal that you want to discuss, you can go on our website, which is there's a link for that here on the page, and hit the book an appointment button and just choose a half hour time that works for you, and we'll meet with you and see if we can help you with something. At least get the ball rolling as far as that goes. So, uh, looking forward to the show today, and I want to thank you again for joining us. Now, I always like to start the show off with a summary of what I see happening with the stock market. And, this week has been interesting in that basically every day, it looks like, including today, the market has been down. So this will be 5 days, including last Friday, that we've had, a downturn in the market, which is, pretty unusual in this marketplace that we've had for at this point in time. All pretty small down days, so nothing too dramatic. But one of the questions that has come up is, why? Why is the market coming down? What is causing this weakness at this point in time? And so I'll kind of start with that thought process, and I'll really start with another question that came in, which was just last week I showed how many job openings there are. And so this goes back, to 2000, and it shows, how many job openings there's been over time. You can see it dropped during the recession here in 2008, certainly dropped here during the pandemic. But look at this skyrocketing motion here. So now we're at almost 11 million jobs that are open, unfilled jobs right now, highest ever. So the question was, look at the trend. So if we look back here, we should be at maybe 9 million open jobs just based on that trend. And the question was, why are we at 11? And it's really fascinating, and this is so unusual. This is definitely a different environment than anything else we'd seen in this trending time, in the fact that although we have all of these open jobs, people aren't taking the jobs. And so what we saw again last week, only 235,000 jobs were created out of these 11 million openings with over 9 million people unemployed. Only 235,000 people took jobs. And so there's a variety of reasons for that, where we have a scenario where, people are afraid to come back to work because of the virus. And so the Delta variant is probably having an impact there. Or they have childcare at home and they don't have a solution for that. Or they've got, up until this week, last week, they were getting an extra $300 a month to be unemployed, a week to be unemployed. That has now expired. So we'll see what happens there. Schools have reopened for the most part, so we'll see what happens there in terms of the child care and what have you. But what you have is this scenario where, we're currently at 5.2% unemployment. We were at nearly 15%, so we've come down quite a bit. But if you look here, prior to the pandemic, we were at about 3.2%. And so we still have an awful lot of unemployed people and a lot of jobs open. That is one of the problems that is causing some of the weakness in the market. And so there are other things that are happening as far as that goes. We've got a Federal Reserve Chairman who people seem to like, who is now up for either re-nomination or replacement, Chairman Powell. So that makes the market kind of get a little sideways. We have a situation with this debt ceiling that has to be approved to increase the debt ceiling for the country. It's a political process. There'll be a lot of probably negative talk. Market won't like that either, and that's probably coming at us. Those two things will resolve themselves. Okay, we're going to have a Federal Reserve Chairman that's going to work out okay. That will happen. We will have a new debt ceiling at some point in time. But in the interim, we're going to see some weakness, most likely. And I actually think it's an opportunity, and I'll show you why here as far as that goes. But one of the things that has happened, and I think the thing to focus on probably the most, because it's the hardest thing to solve, is this unemployment situation. So we have a lot of unemployed, but if you can't get them to come out to work, that means you have a tight labor market, which has never happened before. If you have 11 million jobs open, you're going to fill a lot of them pretty quickly, usually. But what's happened here is that they basically had to pay more. So, where we were paying maybe 3.6% increase in pay, it's now growing, 4.3%. That probably continues to go up. The companies are continuing to get more customers coming in the door, and they need employees to basically service those customers and fulfill their revenue. And so we're seeing this scenario where they're paying more to try to both keep their existing people or hire new people. And so theoretically, that can have an impact on the earnings, correct? I mean, if a company has to pay more in dollars than they used to for the same labor, then you've got a scenario where there could be a drop in earnings. And again, that's something that the market would look at. But I'll tell you what's happening, and I'll show you that that's not so much of a concern right now. So first of all, this is a chart of the gross domestic product going back to roughly 2000, and you can see it dropped down during the 2008 downturn. It dropped down here during the pandemic, and the gross domestic product is essentially the total production of the whole country, all the companies in our country. But look at what it's done now. So it's higher than it was, and even if you draw a trend line on here, you can see we're right back on trend. So if you think about that for a minute, it's kind of an amazing component, is that we are producing as much as we used to produce at 5.2% unemployment, and we were at 3.6% unemployment prior to the pandemic. So we're making more with less people. So that's an increase in productivity. Part of that was caused by the pandemic itself. It pushed the entire world into a kind of a digital world with things like what we're doing here, this show, and Zoom and video conferencing and all of this robotic pieces that are coming in. And so it's very robust. That's what's happening right now. There's a huge increase in productivity. And look at what's happened to earnings. So this is the corporate profits after tax. And so you can see, it was kind of actually sitting around from 2012 to 2020 before the pandemic, was pretty flat. And then look at this growth, unbelievable corporate profit growth. Well, that's why the market's doing so well. And the projections, I've heard some projections that it'll be up 30% higher even over the next 12 months. A big piece of that is that people are continuing to come out for their kind of the reopening and spend some money. There's a lot of money that was saved last year that's being done now, but they are having trouble getting people in. So they're having to sell what they can with the people that they have. And so that is creating higher profits. And that's why higher wage for those people that are coming out probably won't knock down profits that much. Again, if the expectations is 30% profit growth and the wages are going to go up more than expected, then there is some adjustments that the market will make, because maybe it's only 28% profit growth because the wages go up. And so that's really what's happening right now, is we're just kind of adjusting. And all of this started, this 5 days in a row of down, last week, last Friday, when they released the report for the number of people that started new jobs for August at only 235,000, which was much less than expected. So again, it's not because there aren't jobs. It's because people aren't taking the jobs as far as that goes. I think that works its way out at some point in time, but it is going to be a bit persistent. The virus is there, and it's scary to people, and a lot of these jobs are for client facing, and so there's some fear that you could catch that virus, and so that type of thing is going to be the most interesting piece to figure out how we get out of that scenario as far as that goes. I do think that companies will get more and more efficient. I believe robotics, for example, will start to get more and more interesting to companies at all levels, even fast food, just because they need to get some way to produce, because the people are still coming in trying to buy their products. And so if they don't have employees to do that, then they're going to lose out on what they could make. So and so you can see, really what's gone on here. Now, combine this really high profit scenario that we're in right now, right? Unbelievable. This is unbelievable. Really, really amazing. And this is why the stock market keeps going up. But combine that with really low interest rates. So this is the federal funds rate. So the Fed sets rates for banks, and that's what this is. And it really translates all the way through to all the other rates that are out there, loan rates, the treasury yields, those type of things. Now this is going back to 1955, which I just find kind of fascinating. We had this hugely inflationary time period, in the late 70s and early 80s, where the Fed funds rate was 18%, really, really amazing. But look at what happened. So in 2008 we had this big recession. That's what this gray part is here. And they lowered rates basically down to zero and kept them there for a long time. And the market just went bananas. Really good market during that time frame. And, then they started raising rates, and we had a pandemic, and now it's down to zero. So I've shown this chart multiple times, but you combine, a zero interest rate where the banks are paying nothing. I mean, I just had a client tell me that they were being offered, less than 0.5% on a 1-year CD, and they wanted to look at possibly investing that. That's happening everywhere. So money's coming in because of that low rate, and stocks and real estate are the two areas that do really well in low rate environments. And then you combine that with this spectacular growth in earnings. It's a fantastic time to be a stock market investor. And so when the market comes down, like it has been coming down, that's opportunity. And that's why you keep seeing, the buy the dip group come in, and they'll eventually come in here and buy this dip also, most likely, because this hasn't changed. I mean, they will eventually start to raise these rates. And the Federal Reserve is also buying bonds as a stimulative portion of the stock market. They'll eventually start cutting those back, and that will create some problem for the market. But it's not happening now, and so this is a pretty incredible time frame to be a stock market investor, in my opinion. Even with this weakness we've had over the last 5 days, and could get worse, but the worse it gets, the more opportunity will be there, and then eventually you'll see the buy the dip people kind of sweep in. So that's my summary for the week. Very fascinating time frame. This is an unbelievable time frame to be really paying attention and learning from this, and see how this plays out. So look forward to talking to you again about this next week. All right, Eason. So the first question I'm going to kind of present, because it came in this week, and we really, thought it was an interesting question, and we decided to do sort of a deep dive on it and show exactly, how we would do this and what we would do. And so the question is, and this is not an unusual situation. Hey, I am wanting to retire in a few years, and I keep looking at it and trying to figure it out and trying to go, and I can't make it work. It doesn't seem like I'm going to be able to retire when I want to retire. And so, what do I do? Or what are some strategies? Or what are some ways to do this? And this is not an uncommon situation where somebody's, initial parameters, they actually don't work. And so anyway, we'll go through some of that. And I'm going to jump back in between times here and just have some conversations with Eason so we can kind of flesh out some of the pieces too. Eason helps me do all of these financial plans, so he's very familiar with this. So I'll start with sharing my screen. We call this finding a retirement path, and I think this is incredibly important. You basically want to be able to find the path that works for you, and it's very motivational once you find that. So in this particular situation, we're looking at a scenario that doesn't work, and what path does work, and is that path acceptable? And if it is, you got it, and you move forward as far as that goes. So I'll give you, a brief run through of the basics for this particular plan. I made these people up. None of this is real, but it's based on, 35 years of doing these plans and 6,000 plans under my belt. And so, there's some reality to this, but we have Brad and Jennifer, okay, randomly chosen. They're currently 62, right? And so that's an important age. A lot of people come to see us around that time frame. And Brad's employed; he's making 100,000. Jennifer's also part-time employed; she's making 30,000. They're married; they live in California. Okay, so all of those are important data points, and so they want to retire at 65. So in talking to Brad and Jennifer, this is the most important component. They have other things that they desire to do and certain amounts that they'd like to spend, but the most important thing to them is to retire at 65. Because every plan, you can maneuver things around. We can say, what happens if you retire at 67? They don't want me to move that one around. Basically is what they're saying. I hear this a lot. We're tired. We've been working for a long time, and we would like to retire at 65. So then we have to figure out, well, what age are we planning to? How much time are we going to need the money? Well, that's really hard to tell, obviously, but we can use some averages. So if you look at a male age 65, average life expectancy is 92. Female age 65, average life expectancy is 94. So we'll do that, right? At least start with kind of the averages as far as that goes. The biggest challenge in financial planning by far is longevity. If somebody doesn't live very long, then, it's not very hard to accomplish that financial plan. It's somebody that lives a long time. And so you definitely want to push the envelope a bit as to, what you're looking at. I mean, this is 30 years of almost essentially of time that they're going to be withdrawing and using this money. So that's what makes retirement planning a challenge, is kind of making the money last that long as far as that goes. Now, here's some of their other issues. And this has to do with what we call the goals. And really, this is the outflows. This is the money that's going out. And so they have figured out that they need about $75,000 a year, all right, to pay for the things that they like to do, their travel and their bills and everything else that they want to do. And, again, they're retiring at 65. We've also broken out a cost for healthcare. So roughly $9,500 for Medicare once they retire. That will grow at a faster rate than inflation. That's why we build that out. And then we set, we put in a dollar amount for car, truck type of thing, 30,000 every 10 years. We built that out as a separate thing because it's kind of lumpy, and it's just one of those things. There's all kinds of things we can put in there. I'm trying to keep this simple, but this is the basic concept. So here's the outflows. Here's what we want to outflow. Here's, what one of the income sources is Social Security. And so they say, okay, when we retire at 65, we want to take Social Security when we retire. And we think that's the, one of the part of our plan. And so Brad would be getting almost 28,000 of Social Security, and Jennifer would be at almost 14,000 of Social Security. And if they live to their average life expectancy, they might get $1.2 million out of Social Security. So that's pretty cool. And then here's some of the assets that they have. 450,000 in Brad's 401k. He's still adding for the next 3 years, 13,000. And he's going to get a match and what have you too. So Jennifer's adding to her 401k. She has 150, about $1,800 a year. And they saved up about $250,000 in kind of checking savings, those type of things. And so this is their asset base that they're going to be withdrawing from for income needs above Social Security, as far as that goes. They have a house. It's worth a lot, $1.2 million. And they don't at this point have it in their plan to sell it. They want to start off the planning process just saying, hey, what if we just don't use it in the plan, right? So we don't count it. So we'll start there and see what happens. Okay. So now we can run this current scenario through what is called Monte Carlo simulation. So Monte Carlo simulation allows me to push this button. It'll run their plan 1,000 times. And every time it runs the plan, it lets the computer randomly choose amongst the different variables. And so it's really, really awesome. It's a great way of telling. It's supposed to be replicating their life. So if I push this button, boom, here's the Monte Carlo simulation. And if you right away you can tell this is somewhat problematic. There's so many times here out of 1,000 that it ran out of money before they ran out of time. There was 220 successes and 1,000 trials. So that's not very good. Basically, it means they have 4 times out of 5 they're going to run out of money. That's not a comfortable retirement. And so, that's one of the pieces that, we would deal with here. So we've got this situation. They want to retire at 65. They want 75,000 medical, truck, car. They've got Social Security at 65 coming in and all these things, and keep the house. It doesn't work. All right, at least for those parameters, that's not a path, right? I mean, that would be a successful path. Um, and so then it's a matter of trying to figure out what to do next, right? Um, One of the things that we would look at next is really kind of the Social Security arena. And so this is again one of the things that Eason helps with, is trying to, figure out these areas and what, we test and test and test and try to find some of these different things that can work to make some of these plans work.
Yeah, Social Security is important. And the nice thing about it is you really don't have to do anything to get the additional money. There's nothing coming out of your wallet. It's just making sure that you take at the right times to maximize your chance of success.
Yeah, it's a we do seminars, or we were doing seminars before the pandemic, just on Social Security. Pack the house every time, and people are very curious about how you maximize Social Security, and it is amazingly complex. It's incredible how it works, and it's also kind of controversial, honestly, because people are worried about it surviving. Right, that's a big issue that certainly came up just a few weeks ago, and so I should take it earlier. But if you take it earlier, that could be very detrimental to you financially. And Social Security has never failed, even though it's been talked about failing forever, back to the 40s. I remember going to a class on Social Security, and the person teaching the class had a whole bunch of different headlines. And one of them, a Time magazine from 1940, about Social Security is going to fail. Well, it's still here. All right, a lot of times that it is pretty easy to fix. So personally, and the study that I've done, I do not think it's going to fail. So then it's a matter of making the right choice and getting to the right spot with Social Security, especially in a planned situation like this where it's not working under the current scenario. All right, so let me show you what we would do there. Inside of this program, this financial planning program is called Money Guide Pro. We've been using it for a long time. I really like it. Let me describe this chart. I think you'll find it interesting. So the current strategy we're using right here is this 65 for both of them. It's also the same strategy number 3. It's the same concept, but it shows how much they would get, right? With a total amount, probability of success. And then what they call the break-even point is actually, if you took it at 65 versus different ages, when do you break even on that? So this is the case 67, but here's something really fascinating. They could take it now, essentially. They're both 62. They would give up about a couple $100,000 in total, in terms of their amount, if they live to the average life expectancy that's in there, and that knocks their probability of success down all the way to 12%. They almost cut their probability of success in half just because they take Social Security at 62. This would be wildly detrimental to them to do that. And so I think this is something very fascinating to take a look at. They could take it at full retirement age, which for them is 66 and 10 months, 66 years and 10 months. They would make more. They get, more total. They have, probability of success jumps up to 24%. Right? In that case, their break-even point is 72, so a little bit longer, but still probably make it to 72, especially on the average. Or they could take it both at age 70, and this is where they get the most money, 1.4 million. Break-even point is 76. So again, if they live past 76, they're better off taking it at 70. But I'd probably choose this one here where Brad takes it at 70 and Jennifer takes it at full retirement age, 66 years and 10 months, because this is the highest probability of success. And I like that. And I think that this kind of works, allows them to take at least some of it a little bit earlier, almost a year and 10 months past retirement. But more importantly, and this is critical, the bigger one, so Brad has 27,000, she has 13, etc. Uh, the bigger one survives. So in other words, if one of them passes away, the smaller one goes away and the bigger one stays. But look at this, it's kind of interesting. The total amount they'd get at 65, and again, I'm going to round here very simply, but if you add 27 and 13, you get 39,000. Look at that. Just his all by itself is 39,000 by waiting to 70. So if something happened to one of them, they're actually replacing this entire amount that they would have taken at 60. And they're getting, and that's why the probability of success jumps from 22 to 25. And we can see that, if we go in and push the button, there it is. You can see the spaghetti pattern here, so to speak, is at 25%. And so this is kind of a really an important piece of the puzzle, especially in these situations, is trying to maximize that Social Security. All right, so now the next thing we want to look at is the possibility of selling the house. So this is an interesting one. I have clients all over the country because they've moved from here. House values are very high here, and they can usually go someplace else and buy something cheaper. Brad and Jennifer have actually told me that they have a son in Las Vegas, and they don't really want to live in Vegas itself, but they've heard great things about Henderson, Nevada, which is not far away, and some of the retirement communities there. And I actually have some clients that live in Henderson and live in a retirement community, and they love it, and they think it's the best of all worlds because there's no state tax in Nevada. They can tell me that they can actually see the strip from where they are, but they're not in that whole hustle bustle of the Vegas part. They still have this kind of nice town in Henderson, but if they want to, before the virus or after the virus here, they go into shows. There's some great restaurants there, so they kind of have this access. And of course, the airport flying in and out of Vegas, is unbelievable. You can go almost anywhere from there. So, that would be, and prices for homes there are much cheaper than they are here. So they might be able to capture something out of that.
Yeah, and especially in the Bay Area, tapping into the asset of your house is important, or can be important if you're on the essentially with your plan is in trouble, because you have such a big asset here that's appreciated if you've been here for multiple decades. And maybe a sale is good for you, but there's other options if you really want to stay. Like you can tap it using a reverse mortgage. That might affect your how much you give to your estate, but you want to have a successful retirement over giving more money to your estate.
Yeah, it's a good point. I mean, so if you really want to stay in your home, there are some issues, some ways to kind of deal with that. And one is the possibility of a reverse mortgage. Sorry. And what happens there is essentially instead of you taking a mortgage out and paying it back, they actually pay you a little bit a month, and every time you get paid, your mortgage value grows. And so again, that could be detrimental to your beneficiaries, but you get to stay in that home. And actually, one of the nice things about this area so far is the appreciation of homes has been so dramatically good that you'd be able to stay here longer and maybe get even more appreciation than you're taking out in a loan, and your beneficiaries actually do better than moving to Henderson, Nevada. So the reverse mortgages, you have to be careful. Some of them aren't very good, but there are some good ones now. They used to be horrible, but now there's some decent ones. They just have to pick and choose and be a little bit careful there. But it is an alternative as far as that goes. And so, and that's part of this process. And find your path, find your retirement path. And everybody's got a different path. Everybody's got different desires and things that they want. In this case, with Brad and Jennifer, they've said they're okay looking at the concept of moving, in this case, to Henderson, Nevada. So let's take a look at that and see how that plays out, what difference that makes. Okay, so again, Now we go back to their basic information and we put Nevada here instead of California, right? For because now the program will actually calculate the taxes in a different way. It was calculating it staying full time for the rest of their lives in California. Now we're going to say, at retirement, we're moving to Nevada. And so there's lower tax. And so that makes a difference. But you're also theoretically going to be buying a cheaper place. And so let's just say in their case, that they get an extra 250,000. So they sell their house, they pay the realtor, they take care of any moving costs, they put some money into their new place, which seems to always happen when my clients move, or some furniture or something that's needed, and maybe there's some taxes depending on the situation, and let's say they net after all of that 250,000 that they can now put into kind of their investments, and all of these things are invested at 60% stock and 40% bond, except for the checking, which is what we call cash, basically. And so this would be invested in that same 60-40 mixture. And then again, now that we've changed the plan, we can go back and see. So far we went from 22% on the base case, so to speak, to 25 when we maximize Social Security. And let's see what happens if we sell their house and move to Henderson and net 250,000 and lower our taxes because there's no state tax in Nevada. We hit the button here again, and that's a pretty big difference. That moved all the way up to 77% probability with that move. So makes, if they're okay with that, if that's a path that is, acceptable to them, it really makes sense financially. It really does work. And so that's another piece as far as that goes. So it's really, really fascinating. Again, this is why we have so many people that have moved all over the state and all over the country to different places. Um, Not everybody wants to move. I have a lot of clients that don't want to move at all. But I will say those people that have moved, that wanted to move, they've been pretty happy. I haven't heard from anybody over the years, that they were really unhappy with the fact that they moved. The only time I've heard anything, and this is one thing you got to be a little bit careful about, is somebody that moves to a really small rural area like Arnold, or here in California, you can move up into the foothills in Arnold, mainly because, or Sonora, whatever. These are scenarios that I've run into just in my practice, mainly because if they have a health issue, you have cancer, you have Parkinson's, or you have whatever, they don't have the facilities there to really deal with you, and you're having to go out on a regular basis for treatment and maybe go down to Sacramento or Modesto or San Francisco, and a lot of driving, and it just kind of takes away. So I would focus, and that's where like Henderson and Las Vegas, in this case for Brad and Jennifer, makes a difference. They're going to run into some pretty good care facilities there. And if they had to go out for something pretty major, like come back to Stanford, they could get back to Stanford pretty easy out of the Vegas airport, like an hour and 20-minute flight. So those are considerations for that move as far as that goes. But the next thing, though, we're still at 77%. And one of my kind of lines in the sand that I like to try to do, I like to try to get these plans to at least 85%. If you understand Monte Carlo simulation, 85% is probably overkill, but I do like to really make sure that people have a successful retirement as much as we can possibly do that. And so that's where, taking a look now at their budget. As far as that goes, would be kind of the next big piece to take a look at. All right, so go down here. So let's just say we take a little bit off. They had 75,000. Let's say we take that down to 70,000. It's about $400 a month. It's possible, and my client who lives in Henderson talks about how much cheaper it is there just to go out to eat, go to the grocery store, all these things. It's possible, that we could be moving to Henderson and spending a little bit less anyway and still have the same exact standard of living. And so let's just see what happens here if we just reduce that a little bit. And so we would hit the Monte Carlo simulation button again, and here we are. Hey, we did it. We're over 85%. 88% is great. So think about what just happened here. They come in, they're a little bit concerned because it doesn't seem like their plan's going to work, and they're right. retiring at 65, taking Social Security at 65, keeping their existing house as is with no other alternatives, uh, really, it's not going to work. I can say that pretty emphatically. When you're at 22% probability of success, you're going to run into problems. Um, and then they go through a process where we're going to maximize Social Security, and we say, okay, great, that gets us up to 25% probability of success. Brad takes it at 70. Jennifer takes it at full retirement age. So that's good. We live off of the other assets that they've got in the interim. And that's what the plan is showing you. It works. It works better than taking Social Security at 65. And it works way better than taking Social Security early at 62. Then we sell the house and we net some money. We save some taxes by moving to a lower tax state. And we end up with, a 77% probability of success. Cut the budget by a little bit, and all of a sudden we've got a plan and a path that works. I talk to them, we make sure the budget works, they really look at that, they're okay with the home move at retirement, and all of these things happen, and that's their path, that's their retirement path. And now we just keep working on that, and we look at this plan every 6 months to try to see what happens. Does it change? What's the probability of success? Or is the house now worth more, or less? Is the stock market doing well or not? Those types of things that can have an impact. And so that's the overall process as far as that goes. And I think it's really interesting altogether, as far as I'm concerned. Um, Comments, Eason?
Yeah, and the nice thing about it is like, say you want to test different scenarios, like at different like kind of forks in the road. Say we test a reverse mortgage versus sale of a home and moving to Henderson, and we could have both those scenarios, and we can play and just see, maybe they want to move to Henderson as kind of like a last resort. And if they could figure out how to stay at this house, they would do that because they've invested so many years. This is, where they're set up their roots.
Yeah. Yeah, that's the beauty of it. Actually, I mean, this is a fairly simplified, presentation of what you're looking at, and your situation might be a lot more, complex, but we can essentially model and ask questions and get an answer, and usually 1,000, trials to get that answer. This is an amazing time frame to be looking at retirement and retirement planning. The tools that are available are incredible. And yeah, you're exactly right. I mean, we actually do that a lot. Ethan and I will kind of meet before we, present every plan and just start to do a lot of what ifs. What if this happens? What if we do that? What if the mortgage is paid off? Or, whatever it is that, we look at. And we do find some things that consistently work and some things that consistently don't work, so that's helpful for us to kind of guide us in a quicker fashion. But it's really, really interesting as far as that goes. I find this, work to be fascinating as far as that goes. Now, the one thing we didn't really talk about too much is kind of the investing arena, because it is important to try to get the best rate of return that you can. That's for sure. And we've created a scenario here where we've got 60% stock and 40% portfolio. We're just looking at kind of a generic scenario. I just wanted to show you what our portfolio looks like for those mixtures, so you can get an idea of how it works. And so this is our 60% model here, and you've got a scenario where the blue is kind of the stock and the green is the bond. So here's a couple things. Number one, I'm a big believer in buying basically the whole market. I'm also a big believer in buying exchange traded funds, which are very well diversified pieces. So give you an example. This is the Vanguard Total Stock Market Index. It has a little over 3,800 different stocks, which is almost all of the stocks in the U.S. market. We can buy it with one ticker symbol, VTI, very simple, and we can buy and sell this. There's no commission to buy or sell it either, which is really nice. So that's a piece. I'm a big believer in using the biggest companies in the country that provide exchange traded funds, which are Vanguard, which is number two, and then iShares is owned by a company called BlackRock, and so that's number one. That's the biggest. provider of exchange traded funds. And then Spider here, SPDR, is actually a company called State Street back in Boston. They're the third biggest. And so if you look, you'll see an awful lot of those three companies. I like, they kind of are big enough to get enough volume into these ETFs. They'll be around for a long time. And also that bigger size allows them to lower the internal fees. I believe the internal fee, for example, on this total stock market index is now 0.03%. So very, very efficient portfolio with this mixture. We can buy the S&P 500 with one ticker symbol instead of buying 500 stocks. We can buy ESG stocks. So this is in the portfolio because these are doing well. So this ESG portfolio here, this Vanguard ESG portfolio, is actually exactly the same as this total stock market, but what they've done is applied an ESG screen. And so in that screen, what they're doing is they use an outside company to analyze all the different companies out there, and they give them a number based on how they interact with the environment, how they interact with their community, how they interact with their employees. And ESG stands for environmental, social, and governance. And so in this particular portfolio, they're only buying those stocks that are here in the total stock market that meet a certain ESG number. These have been doing very, very well. So that's why they're in there. I know I like big stocks because they're safer, in my opinion, more liquid. So the top 200 stocks on the growth side, top 200 stocks on the value side. Healthcare and utilities is doing quite well right now for a variety of different reasons. So, we've got our bond portion here with treasuries, and this is the total bond market index, which has, just tens of thousands of different bonds in it. So the diversification is unbelievable here. And if somebody wants to get income, like let's say Brad and Jennifer, when they retire, if they don't take their Social Security, what we would do is we increase this money market to 5%, and we take the money from the money market until it runs down, and then we rebalance the portfolio to bring this back to 5%. It's what's called a systematic withdrawal. So this is how we would handle Brad and Jennifer's, income need, especially during that time frame when they're not taking Social Security. As far as that go, probably take it out of their trust account first, and then eventually take a look at their 401k IRA assets as far as that goes. We also have a pure ESG portfolio. So for those of you who are really, really interested in kind of that social responsible portfolio, this is all ESG pieces, ESG screened. This is the S&P 500 for ESG, etc. So we can accommodate that, and we've had these portfolios for a long time, and they're very efficient and have done quite well. Actually, been very, very pleased with that. So uh, that's important component of it. If the plan is saying, okay, here's the averages and here's what's going to happen, and Monte Carlo simulation is looking at some bad situations, but you got to be careful that you don't create those bad situations yourself by going into the wrong invested areas, and really, finding a situation where, you don't want to hamper your own abilities, your own retirement plan by having, horrible advice. And unfortunately, that does happen. But try to keep that to a minimum. I think that's important because that would help, especially in this situation where you're, kind of on the edge of making it work just right, as far as that goes. So, any closing comments, Ethan?
Yeah, like especially finding that your correct risk tolerance and finding that for your portfolio. If you're that 60/40, being able to stick through that will really help you in the long term.
Yeah, that's a big piece that I didn't really cover, which is just, we just randomly chose a 60/40 mixture, 60 stock, 40 bond, because it's very popular. Our overall practice is roughly that right now. I think we're 63% stock across all of our accounts. But everybody's got a different personal risk tolerance. And so that would be a part of the planning process. And maybe for you, you really can't handle more than 20% risk, and that's okay. And so that's your path. That's part of the path, and we got to figure out what that means. Or you really like more risk. You believe in the stock market more, and you really want maybe an 80% portfolio, and we can do those too. We have basically our portfolios go by 10% increments from 0 to 10 to 20 to 30 to 40, all the way up to 100% stock. And so that, we can accommodate those risk levels, but that's a good point. That's a super important area altogether of this whole, concept, is just making sure that you're matching the risk. The plan can say you need a certain level of risk to make it work, but if your personal tolerance is lower than that, you need to readjust the plan to that lower tolerance and find the path that works. Because in the end, if you're taking more risk than you can mentally handle, you will lose. That's been my experience. So that is a part of the process that we would normally go through there too. So it's a good point. So um, really want to thank everybody for watching today. We spent the whole time covering this, big case. I hope that you pick some things up from this. Because the interesting thing about retirement is whether you're 20 or 80, there's an awful lot of things that go on that, are kind of consistent. And again, the more you kind of understand how you do it, and how it works. So if you're 20 and you want to retire at 55, okay, learn about retirement planning, learn about asset management, learn about how to manage the taxes, because that will make it more possible for you to retire early and make it more secure for an early retirement. If you're in your, already retired, making sure that you understand or have advice on financial planning, the asset management, and the tax planning will have a better chance of making sure that you don't run out of money some point in your retirement. So anyway, those are the key pieces. I want to thank everybody so much for coming. I so much enjoy doing these, and I love all the feedback. Again, if you want to set an appointment, you can go right to our website, hit book appointment. We'll talk to you. If you want to subscribe, you can do that. If you want to give us, your email address to get on our email list so we can send you the links to these videos, you can do that also. Just send it to this Talk Money with Tom, email address. And, again, we do this every Friday at 12:15. Look forward to seeing you next Friday. Thank you very much.